Welcome, everybody, and thank you for joining us today. Before we get started, just a couple of technical tips to make today as useful for everyone as possible. First of all, we want to make sure that you're viewing the webinar today in full screen. So just a couple of tips. In the upper right-hand corner of your screen, you'll see a view icon. If you click on that small icon in the upper right-hand corner, we'd like for you to make sure that standard is selected at the top, and then at the bottom, make sure that you're in full screen mode. Today, we're going to be going through a number of topics that we think are going to require a whole lot of questions and interaction, and we want to encourage you to ask questions. And the way we're going to do this is everyone's line's going to be muted to block out the background noise, but you'll be able to ask us questions just as you have in the past through the chat icon. So you'll see at the bottom of your screen, in the ribbon at the bottom of your screen, towards the middle, you'll see a chat box. And if you'll simply click on the chat box and type in your question and send, it'll come to us. No one else should see that question. And if you just enter your questions at any point, no need to wait till the end in case you forget them. Just enter your questions as we go, and we'll stop periodically throughout the webinar and answer questions. But again, a lot of our discussion today on the Charles Schwab TD Ameritrade merger, we want to encourage you to ask questions and make sure that you get all the information out of this today that you need. We are going to be discussing performance today. So just a quick disclosure, reminding you that past performance is not a guarantee of future results. If you do have any questions on any of the performance information we share today, you're welcome to ask or talk with your advisor. So what do we have on the agenda today? Well, the time is finally here. Charles Schwab purchased TD Ameritrade about 3 years ago, but they've continued to operate as separate entities up until now. Labor Day weekend, our clients with accounts at TD Ameritrade will transition to Charles Schwab. No doubt you've gotten a lot of information in the mail, potentially via email from us regarding this topic. And our operations team here has been working hard to get prepared for the integration. And they have a number of updates for you today on exactly what to expect coming up here over the next month. In addition, several members of our advisor team have prepared some thoughts for you about the current market environment. The last 12 months have been full of uncertainty, speculation, and volatility, and our team has gathered some thoughts and data to give you our perspective on current markets and the opportunities that have presented themselves for investors. So who's going to be talking to you today? Really, we have our whole team, by and large, on the line today. So today you're going to hear from nearly everyone on our team. And before we begin, I want to give a special thank you to our operations team, headed by one of our newest partners, Rachel Rand. Rachel, Bryn, and Nate have done a tremendous job getting our clients and our advisory team ready for the transition to Charles Schwab. After working for the last 21 years on the TD Ameritrade software platform, they've been onboarding all of our new clients the last 5 months to the Charles Schwab platform, all while making sure we're ready to transition everyone else to the Charles Schwab platform over Labor Day weekend. Anyone that's gone through a system and process integration or change like we're going through here over the Labor Day weekend knows it's never easy, but they've approached it every day with a smile and a positive attitude. And for that, I say thank you.
All right, thanks, Mike. To begin, we are going to talk about the Schwab TD Ameritrade merger first. And today we'll be covering who is Charles Schwab, our client advisor relationship with you and how that's not going to change, important details you need to know about your accounts, our upcoming timeline, as well as resources about the merger, and we'll make sure to leave time at the end for your questions and answers. So before we dive into discussing the merger, As Mike mentioned, we wanted to take a moment to acknowledge that we have exclusively been onboarding new clients to the Schwab platform rather than TD Ameritrade since the end of March. So if you have recently started working with us, you are already set up on Schwab. For all of our clients who currently have accounts with us at TD Ameritrade, those accounts will be transitioning this Labor Day weekend. So to begin, who is Charles Schwab? Schwab started in the 1970s as a discount brokerage firm, and today Schwab is the nation's largest publicly traded investment services firm with around $8 trillion in client assets. Schwab has expanded from its roots as a discount brokerage firm and also provides a full-service investing and banking experience to clients both domestically and abroad. So with $8 trillion in assets, Schwab has about 34.4 million active brokerage accounts. 1.8 million of those include banking accounts, and there are 2.4 million corporate retirement plan participants on their platform. All this to say, the scale of this transition is not insignificant. Schwab is transitioning over 10 million accounts. They did start this transition over Memorial Day weekend and have been transitioning both institutional and retail clients throughout the summer. So now it is almost our turn. Mike's going to take a second to talk about Schwab's business model.
So if you think about how Schwab works, they actually work very similar to the way TD Ameritrade has worked for the last couple of decades. We've used them as our custodian. So Schwab really serves three different market segments. The first is the institutional business, which is what we're a part of. Charles Schwab now serves as the custodian for a little over 14,000 independent registered investment advisory firms. And that institutional business makes up almost half of that $8 trillion in assets. The other $4 trillion in assets that Schwab custodies is in their retail business. And again, very similar to TD Ameritrade, Charles Schwab has a huge business serving as the custodian for do-it-yourself retail investors. Where Schwab is a little bit different than TD Ameritrade is on that retail side, they do have in their branches across the country their own wealth advisors that work as employees of Charles Schwab servicing retail clients. So probably the most important takeaway here for you is that we will not be employees of Charles Schwab. We've had several questions about this over the last couple of months. Our relationship with Charles Schwab will really be no different than our relationship was with TD Ameritrade. And none of us will become employees of Charles Schwab. We will simply be one of the 14,000 independent advisory firms that custody their assets with Charles Schwab.
So to further illustrate this, on the left, you can see what we have been working at with TD Ameritrade. So you work directly with us and we work with TD Ameritrade on your behalf. You have no real interaction with TD Ameritrade. They are simply the custodian. And then Mike will explain the new state of affairs, which is on the right.
Yeah, and I think the good news here for clients is nothing will change. The custodian will simply change from being TD Ameritrade to Charles Schwab. So our relationship with our custodian won't change. And just as our clients have rarely, if ever, had a need to contact TD Ameritrade directly, the same will be true with Charles Schwab. Any questions you have about your accounts will run through us and our team here at Aspen Capital Management. The other thing that will remain the same is our relationship with asset management firms like Dimensional Fund Advisors, Vanguard, or any other investment firms that we work with. Those relationships will be exactly the same. So basically, from our client's perspective, you'll have a different login, you'll go to a different website, and you'll receive statements from Charles Schwab rather than TD Ameritrade. Other than that, from the client's perspective, there really should be no difference in the relationship.
All right, so there are a few different pros and cons of this merger that we have encountered so far, and we wanted to share with you. So I will take the pros. First of all, the size and scale of the company is going to allow Schwab to make better investments in their offerings. So two areas that we've seen this is that Schwab offers better and more robust cybersecurity, as well as more mobile capabilities. And we've been working with Schwab for about a year throughout this merger transition, and we have seen both of those areas come across strong and clear as major pros of the transition. Additional pros include Schwab's banking and lending capabilities. They will have more options for you as clients on the banking and lending fronts. And Schwab truly is the market leader in the discount brokerage space.
Rach, I'd also point out on those pros, the cybersecurity and the mobile capabilities, those are really both for us as advisors as well as the end clients. You'll notice in the future that through your mobile app with Charles Schwab, you'll have the ability to do more things like moving money than you had with TD Ameritrade. So we wanted to be really transparent. As any of you that have ever gone through a merger or acquisition know, not everything is rosy, and there's always downsides to it. And so we wanted to be completely transparent with you about the things that we've seen so far in the last 5 months as we've been working with Schwab. And just as being a market leader is a positive, and it gives Schwab the size and the scale to invest in different areas, along with that also comes an organization that's more difficult to work with. They have slower response times, and we've found that they're less technologically advanced, which I know seems odd given that they've made more investments in mobile technology and cybersecurity. But in the platform that we interface with Charles Schwab on, things are our operations team is required to do more things manually or via the phone with Schwab than we could just do online with TD Ameritrade. And then I already mentioned this, but I would say the other is we definitely see that for us, this should have no impact on you as clients necessarily, but for our operations team, the support times with Charles Schwab are definitely slower than they are with TD Ameritrade. So the final thing I would say here is that throughout the merger, TD Ameritrade and Schwab have worked to merge their capabilities together to really attempt to try to achieve the best of both worlds. So we will hopefully see, as you merge over to Charles Schwab and as we do as well, hopefully you'll see on the technology side, there will be some things that are different, and hopefully some of those things are better because there are areas that Charles Schwab was a little bit more advanced than TD Ameritrade, and they're doing their best to merge those together.
All right, thanks, Mike. This is Bryn Penner speaking, and I will be going over your key information packet, Schwab Alliance login information, and information regarding linking your household accounts within the Schwab Alliance platform for view-only access. By now, every client should have received their key information packet in the mail. Please note that you will have received a separate letter for each account you have at TD Ameritrade. This packet has your new Schwab account numbers, which you can reference in the future. Within this packet, there are also instructions to log into your advisorclient.com account, which is a legacy TD Ameritrade platform. Once you log in, it will immediately prompt you to set up your Schwab Alliance credentials. Schwab Alliance is the new version of advisorclient.com. After the transition takes place, you'll be able to use Schwab Alliance to authorize move money requests, update account information, and obtain custodial monthly statements. If you go to our website, you will see under the Online Client Center tab, you now have access to the Schwab Alliance login. You can see here the new access point you will use. We recommend bookmarking this page. The Aspen Capital Portal and your retirement plan login will not change and can still be accessed on this page. Please note that until after the transition fully takes place over Labor Day weekend, current TD Ameritrade clients will only have a limited view of the Schwab Alliance platform. One question we have received quite often, and I'd like to address, is you may have noticed if you've already logged into your Schwab Alliance account, you are not able to see all the accounts within your household. This is because when you log into your new Schwab Alliance account, you will only be able to see the accounts which are linked under your social security number. Don't panic though, because once the merger takes place, you will be able to go into your account and give view access to all household members. We will send out instructions in early September for this. Now on to Nate Berman to talk about cash management.
Thank you, Bryn. So I'll be continuing on with some cash management items as they relate to the Schwab merger. To start, I do want to confirm that move money links that originated from TD Ameritrade will move over to Schwab accounts automatically. In other words, these are the move money links that were established by signing a DocuSign form, giving us the authorization to push or pull funds from your TD Ameritrade account and an external bank account. So if you have historically reached out to us to request that we move funds between your TD account and bank account, those links will transfer over to Schwab. In addition to that, move money links that you set up personally through TD Ameritrade's advisorclient.com will transfer over to Schwab as well. However, the link that will not transfer automatically to Schwab is a link that originated from the external institution or bank. If you set up a move money link to push funds from your bank or external institution into TD Ameritrade, and you did so through the bank's website or mobile app or working directly with the bank, that link will not transfer over to Schwab. To establish this link post-merger, you will need to follow the same process that you originally used, but this time with your new Schwab account and routing number. Your Schwab account numbers are in the key information packet that you received recently in the mail and can also be found on Schwab Alliance. Finally, for the cash management items, for those of you who have active checking and debit card capabilities on your TD Ameritrade accounts, we have recently been in contact with you. And just as a reminder for those of you, if you have checking or debit capabilities on your account active and have used a check or debit card in the past 2 years, the following dates below pertain to you. So moving on to the timeline, we're currently at the green dot, which is today, August 15th. And as of today, all new accounts will be opened at Schwab, not TD Ameritrade. In addition to that, all new account transfers or asset transfers will take place after the merger at Schwab. And between now and Labor Day weekend, the most important item to focus on is setting up your Schwab credentials. And as we move across that timeline towards Labor Day weekend, we'll see that both trading and cash management will be available at TD Ameritrade through the end of the business day on September 1st, Friday, which is that Friday right before Labor Day weekend. In other words, there will be no disruption in placing trades or transferring out cash or transferring in cash into TD Ameritrade.
Then over Labor Day weekend, you will not be able to access your TD Ameritrade accounts. On Tuesday, all assets will have transferred over to Charles Schwab. In addition, starting on Tuesday, you will begin using Schwab Alliance as your primary custodial login rather than advisorclient.com. On Tuesday, September 5th, account verification letters will be mailed out for each account. Be on the lookout for those in your mailbox in early September. No action is needed by you, but please look over them and keep them in your records. We are excited to share that we will be hosting a post-merger webinar, so mark your calendars for Thursday, September 7th. There will be more details to come on that. Lastly, you will receive September monthly statements for both TD Ameritrade and Schwab in early October. This will be the only month with an overlap of custodial statements. Now I'll hand it back over to Rachel to go over the resources we have available for the merger.
Thanks, Bryn. So before I go over the resources, I just wanted to take a second to remind you to be entering your questions. After we go over the resources, we will move to a Q&A time in the webinar. So if you've thought of some questions, now is a great time to enter them. So, as Bryn mentioned, we will be hosting a webinar on September 7th at 12 p.m. Mountain Time, 11 a.m. Pacific Time. And this webinar will address top functionalities of Schwab as well as frequently asked questions. That week following the merger, we also will be available to answer phone calls and emails with one-on-one questions. We've blocked off time on our calendars to be available for your inquiries. And we will have all video tutorials on our website going over how to navigate Schwab. So I'm going to take a minute to exit out of this presentation, actually, just to show you how to access that. So on our website, if you navigate to the top resources tab, second from the bottom, we have a tutorial library. On this tutorial library, you can see we have videos going over how to navigate the Aspen Capital client portal. This will not change because your client portal isn't changing. But if you scroll down, there also are videos for TD Ameritrade. We will be replacing all of these videos with how-to videos for Schwab. So we'll cover all the same topics as well as any additional topics that we find helpful. And scrolling down to the bottom, there also are PDF resources that we'll upload for Schwab, just in case you prefer reading rather than watching videos. And these will all be uploaded on Friday, September 1st, so you'll have access to everything prior to your accounts transitioning. All right, to revisit the presentation, we are now going to move into a question and answer session.
Looks like we had a few questions come in. The first one is for Bryn. Will we still be able to access all our household accounts with a single login?
Yes, you will be able to if you give view only access. That will happen after the merger where you can go in and give other household members viewing access.
And then Rachel, if we are already Charles Schwab customers with individual accounts, when TD accounts move over, will anything happen to those individual accounts?
So if you have your own separate Charles Schwab accounts at this point, you should be able to link your TD Ameritrade accounts to your existing login credentials. So the system will identify the fact that you already have Charles Schwab accounts, and it will allow you to link everything under the same login.
And then Rachel as well, if we're out of town and can't set up our credentials before Labor Day, is that okay, or will that create problems?
It definitely is best to set them up before Labor Day because I think that will reduce any potential complications. However, it is possible to set them up afterwards. You just will no longer be able to set up your credentials through TD Ameritrade's advisorclient.com. You'll have to set them up separately, but we'll have instructions about that. And instructions were also included in the key information packet about that.
Hey, Rachel, let me ask you a further question on that. Is there a way to log into TD Ameritrade now that will prompt you to open up the Charles Schwab new login credentials without the paperwork in hand?
Yes, Katie, that is a great question. I'm glad you asked. If you don't have the paperwork in hand, we recommend that you log into your advisorclient.com account at TD Ameritrade. You're able to access that via our client center. And if you don't remember your user ID, we're able to provide that for you. And once you log in on the homepage, there will be a link to set up your Schwab credentials. And we've found that this process is actually a little bit more straightforward than using the paperwork to set up credentials. So we would recommend it as a best practice for everyone to set up their Schwab credentials via advisorclient.com.
Hey, Bryn, one more question on getting visibility to both you and your spouse's accounts. That's a question that I know the advisory team has fielded several times from different people. Will we have training, a video, or directions for people on how they can do that?
Yes, we will add that to the resources. We will send out after the merger instructions of exactly how to link accounts.
And just so we're all on the same page, Bryn, the merger happens what day?
Labor Day weekend.
And Nate, we have a question for you. Do I have to change anything to change my monthly deposits into my bank account?
Into your bank account from TD Ameritrade.
Yes,
I
sir.
The short answer is no. The recurring transfers and all cash management items, those will proceed either on TD Ameritrade before the merger up till through September 1st or at Charles Schwab. So there's no need to redo your recurring transfers. The only thing that you will need to redo are those external bank account money links to push money into TD Ameritrade currently and then Schwab that we didn't set up through TD Ameritrade. So that's the only thing that won't automatically move over to Charles Schwab.
And then Bryn, can you give us a amount of time that it takes to set up the credentials on Schwab?
Oh, that's a great question. I would say allow yourself for about 10 to 15 minutes to be able to get into advisorclient.com and then go into the Schwab Alliance credentials and get that set up. There is two-factor authentication, so that makes it take a little bit longer.
And I'll chime in on that one too. This is Rachel. Just to note that if you're having trouble, we are happy to get on the phone with you and walk you through the steps. We've actually done that for a few clients already, and we are available to help walk you through that if you're running into problems.
And then Rachel, for individual stocks held with TD Ameritrade under our custodial account with Aspen Capital Management, how will those stocks be affected with the transfer?
So everything will be transferring over at the same time, and both the assets and the cost basis will transfer over. So everything will be reflected at Schwab exactly as it has been reflected at TD Ameritrade.
And then for Rachel as well, a two-part question. Can you review tax reporting? And also, will we use two different reports from the two custodians for tax reporting?
That is a wonderful question. I'm glad that one was asked as well. So you'll be able to access all of your information from TD Ameritrade for the year, as well as information from Schwab moving forward. Like Bryn mentioned in the presentation, you'll receive a monthly statement for the month of September from both TD Ameritrade and Schwab. And then with tax forms specifically, you'll be receiving tax forms for 2023, both from TD Ameritrade and Schwab, to make sure that everything is covered. And we'll send out more information about that at the end of the year and beginning of next year. But all of the tax reporting information will be available from both.
And then Nate, if a client has checking and debit capabilities on their account, when can they expect to get those checks from Schwab?
It's a great question. They can expect actually to get those checks or debit card in the next about a week from now. So I think it's August 21st through August 28th is kind of the window of time to receive those the checkbooks, the new Schwab checkbooks or the new Schwab debit card. So those are currently being sent as we speak.
And Rachel, we have two accounts, but only received one Schwab number. What should we do / who should we contact?
I would reach out to us about that specifically. Feel free to shoot me an email. My email is rachel@aspencapitalmgmt.com. And we can look into everything on the back end for you. If you didn't receive any mailings you were expecting, or if the information you received was different than you would have expected, we're happy to investigate those details.
And it looks like that is all the questions we've received so far, but please keep filling in the questions in the chat box.
All right, thank you, Trevor. We are going to move on now to the advisory portion of the webinar.
Great. Thank you, Rachel. And thank you to Bryn and Nate as well for covering everything from an operations standpoint. As Rachel mentioned, we're going to shift gears into the advisory portion of the webinar. This is Jake on the advisory team here, kicking us off. And we just wanted to say thank you again for sticking around. Now that we've got the important stuff out of the way, we're going to switch gears and talk about the market a little bit. So Katie, Lavia, and I are going to start this off with a couple of thoughts on what we've seen in markets recently. And then we're also going to touch quickly on some of the big headlines from the year, such as recession fears, inflation worries, as well as James and Mike wrapping it up for us with the topic of AI, or as many of you have heard about recently, artificial intelligence. So let's get to it. Katie, lots happened in markets so far this year.
Yep.
What story or event do you think through the first 8 months of the year has had the greatest impact on markets?
Oh my gosh, one story or one event. Well, like you said, there's just been so much that's happened already in these first few short months here in 2023. I mean, I would say the small bank crisis was a huge one, Silicon Valley Bank, the debt ceiling and the government almost defaulting. That was also a really big story that caused some market movement for sure. Also, most recently, the downgrade of U.S. debt by Fitch, that was something that we saw, move some markets. So I don't know which was the most impactful. What do you think was the most impactful story?
And you brought up the three big ones right there. I'd also say continued concerns around Russia and Ukraine and the ongoing situation and war there.
Yeah.
But I think you really hit on the key point that there has not just been one topic. It's been a lot of different things.
Yeah. No, I think you're right. I think that is the story, right? Like if you have been watching markets daily or have been watching markets as these events have played out, you've probably had some high blood pressure this year. It's probably been stressful for you. But believe it or not, even after all of those events that we've just discussed and even more, every single asset class across the globe is still up this year. And I don't think anybody predicted that at the beginning of the year, especially after last year's markets. So volatility, I think, has really been the story this year. I think it really started back in 2020 with COVID. So what I want to do today, Jake, is really kind of start to share what we've seen as far as performance by going back to 2021.
Yeah, Katie, I've got up here on the slides the 2021 annualized returns by asset class. So for those of you on the call today, these are going to be the core assets and most of all of your portfolios. So Katie, you mentioned you want to jump back to 2021. What were some of the key reasons why you wanted to step back a few years before we work to where we're at today?
Yeah, well, I just think it tells a really interesting story. I think we think it's interesting. Hopefully you all think it's interesting too today, but it kind of goes back to how we're all feeling. I want to help you remember how you were feeling at the beginning of the year when we started some of these time periods. So let me take you back to the beginning of 2021. So we were just coming out of COVID. Lots of economies around the world were completely shut down. We just had a great return the previous 6 months and investors were wondering if it was going to continue. And then boom, we backed the COVID rebound with another really great year. Even amidst all the worries of the pandemic and a looming recession combined with rumors of mass layoffs, all of this we experienced through that. All of this we experienced one of the best equity markets on record. And now let's kind of go through 2021 and think about 2022 and how we started that year and how we were feeling. And I think feelings were mixed at the beginning of 2022. I know lots of my phone calls, feelings were mixed. Investors had different emotions around what was going to happen in 2022. Things felt like they were getting back to normal, but we knew inflation was still an issue. And what happened next? Well, we followed up a year of all greens, almost all greens, with a year full of red, and every single asset class was down. In fact, it was the worst bond market on record and the 7th worst equity market on record. Tough year last year.
Yeah.
And that brings us now to the beginning of 2023. So we had all of that volatility. We saw a really tough market in 2022. And I kind of want to go to Livia now. Livia, you gathered some data on this. What was the media and the financial prognosticators really saying at the beginning of 2023?
Gosh, Katie, the beginning of 2023 feels like so long ago. There's so many things that have gone on. You mentioned inflation climbing. Pessimism was at an all-time high all the way through April of 2023. We had the Russian energy shock, the banking crisis, the debt ceiling debate, and now the recent downgrade of the U.S. debt rating. So experts really have been calling a recession with such conviction, actually more so than they ever have over the last few decades. And in fact, in the fall of 2022, Bloomberg actually published an economic model stating the odds of a U.S. recession were 100%. We were promised a recession because it was the only solution to the rising inflation. But we actually find ourselves in a much different place now. Inflation is falling, unemployment is at historic lows, GDP is still growing in positive numbers and wages are rising. This is not the recession we were promised, which is to say that if one had actually acted on the expert forecasts and their views, they would have left double-digit year-to-date returns on the table. That's an expensive mistake. But the fundamentals continue to show up. You simply cannot time or accurately predict recessions in advance. You've got to let the market do the work for you. As a result, we find ourselves in a much better position than the experts said we would be, and this has actually played out in a positive way for our clients.
Yeah, so kind of to piggyback off of your expensive mistake, Livia, that comment, let's go to what actually we're looking at here. So 2023 returns from January to the end of July. You can see here are green across the board. So every single asset class, again, across the globe is up in a nice way in most of these, especially in these equity asset classes. So you can see that US core equity, which is benchmarked to the Russell 3000. So really the US markets are up around 17.64%, again, through the end of July. August has shown some more volatility, again, really short term here, volatility in August, but at the end of the July, up over 17.5%. And you can read kind of throughout those asset classes. I don't need to read it to you, and see kind of how well we've done, even after all of that Livia just mentioned, and kind of how people were feeling at the beginning of the year, Jake.
Yeah, Katie, Livia, I think you both brought up some really interesting points there. Livia, I want to touch quickly on one of the things you mentioned of the market prognosticators being wrong. We recently saw some data that 14 of the 15 largest financial institutions in the country and in the world have been wrong in their predictions already, only 8 months into the year, on where the market would go in 2023. And so just listening to those headlines can put you in a different state of mind than what actually is going to happen in the markets. So guys, as we bring this all together, these last few years certainly remind us that no one can consistently find investment success simply by timing markets. And even if we think we know what's going to happen, whether that's high inflation or a possible recession, potentially some political or geopolitical unrest, the data shows it really is difficult or even impossible to know how the market's going to react to those types of events, and whether we'll have positive or negative market swings when the market does react. And while these events have been really important and they have been big headline news, it really comes back to what Katie said, that this is just a story of volatility. And once these things come and go, they just get added to the historical list of volatility. And at these trying times, which we would define as disciplined long-term investors, have the opportunity to refocus on some core principles, regardless of what the current crisis might be. To us, some of those principles are in any of these crises that have remained true, whether that was last year in 2022 or in COVID or in the financial crisis now 15 years ago. The first one would be, that market declines, we view these as potential opportunities, both as an opportunity to buy asset classes that have declined in value and offer a value below what they were selling at previously, or as tax opportunities for strategies like tax loss harvesting. And the second is that recessions are backwards looking. And if you wait for a recession, you will miss the returns. What we see is that historically positive returns have come in bunches following market declines and recessions. But the problem is you can't time it and you don't know when things are going to flip. And if you just look at when recessions are announced and are announced to be at an end, the market has already moved well in advance of both of those times. So Livia, do you want to kind of step back and go through one of the slides that we went through in our February webinar that kind of talked about this exact thing, but now with the benefit of hindsight?
Absolutely, Jake. So now remember, the theme here is to let the market do the work for you. You must stay in the market to benefit from the returns. So as Jake mentioned, this chart is a flashback from our February webinar. And it simply shows the performance following a 25% decline in the market over various periods. And we shared with you back in February that you would expect, long-term investors would expect to be rewarded for staying in the market. And so we see those long-term averages, 3 and 5 year. And we reminded you back in February that you do not get the 3 and 5 year almost 10% returns without being in the market in that year following the decline and getting that 20% return. However, let's think back to the headlines we talked about earlier in this call and see how they compare to what actually happened in the market. January through October 2022 had a 25% decline, right? So that's keeping with the theme of this slide of prior periods. That was difficult. It was certainly uneasy, and anyone who had their annual review in late summer or fall last year certainly needed a cocktail afterwards, even if you don't normally drink. And yet we see the market did what the market always does. It looked ahead and priced in all of the data just as it does every millisecond of every day. Positive returns started to show up in the fourth quarter, yet the negative headlines continued. Then the market reached a positive 14.6% return by March, just 6 months after the October bottom. And remember, this was 1 month before negative sentiment peaked in the US based on the different surveys and polls. Finally, by early summer, the word recession began to fade from headlines, and still by July, the market continued its march up and to the right, clocking in at 28.29% return on an annualized basis. So recall, in October, we were guiding clients about which actions to take, like Jake mentioned, and we were focused on the ones that were in your control. Review your plan, you were reinvesting in dividends, you were making tax loss harvesting trades, rebalancing portfolios. But what our clients never did was leave the market to sit on the sidelines in cash, because we know, and you know, time in the market is far more powerful than timing the market.
Via, thanks for talking through that. And we don't want to belabor these points, but we did want to put them up here again, just because we do think they're so important and they remain consistent throughout various periods of market volatility. So again, points 1 and 2 are the same from above, that market declines can be viewed as opportunities, and that markets are incredibly hard to time, and recessions are even harder. And lastly is this third one we want to put up here, which is going to kind of lead into our next topic, which is that time in the market is more powerful than timing the market. So Katie, do you want to talk to that a little bit?
Yeah, I mean, it comes back to there's just a better way to invest. I don't think anyone would argue that there's a behavioral component to investing. It's because we're not 100% rational human beings. We're irrational. We react on emotion. Behavioral scientists and psychologists are still trying to explain why we all want to time markets. Some say it's ego, some say it's control, some say it's just fun. But at the end of the day, most investors will try to do it, even if the data clearly shows we don't have to do it to be successful. We just need to have time in the market. So I think this last slide we're going to share with you, of course, it's a busy graph, but the story it's telling is not complicated. In any one year, there is a better probability you have a great year or a horrific year than an average year. An average year is just not likely. Look at the data in the light blue. The annualized average rate of return over the last almost 100 years is 10%. However, the S&P 500 has only actually returned within 2 percentage points of 10% 6 times. Only 6 times. There's been multiple years of sky-high market euphoria, but also disastrous years that felt like 2008. And that is the hard part to investing. Volatility is certain, but for investors that tuned out the noise and stayed disciplined, those investors have been paid a 10% annualized average rate of return. That's 10% compounded year over year. Jake, do you know what a 10% annualized rate of return is on $2.5 million over a 10-year period?
Katie, you know I don't have my calculator sitting here. I have no.
Okay, I'm going to help you out. It's $6.5 million.
Okay.
$6.5 million. Okay, do you know what it would be over a 20-year period? Do you have a guess?
Let's go 13.
That's $16.8 million over a 20-year period. So I think I'm just going to sum it up by saying there's two ways to make money as an investor of equities. Number one, you can choose a diversified portfolio where you own all companies, winners and losers, and stay disciplined through volatility, allowing your good companies to grow and compound your wealth. Or you got to get really lucky year over year, time and time again.
Thanks, Katie. We have a couple of different topics left that we're going to transition to for the rest of our discussion. As I mentioned at the top, Mike and James are going to talk a little bit about AI. We also mentioned that we talk a bit about inflation. For the purposes of time, we're going to transition this over to Mike and James. But before we do, we just wanted to give you a quick update on where we're at with inflation. Livia pulled some very specific numbers of rolling 12-month inflation over the last couple of years. And where we were at last summer was at 9% year over year inflation. And where we're at today is now well below that at 2.9%. And so this kind of gets to some of the things that we've mentioned in the past about sticking with your financial plan, staying consistent, and not making any big changes for one-off or what might have been potentially transitory short-term inflation to your long-term financial plan. So Mike and James, I'll let you guys take it over and talk a little bit about AI.
Great, thank you, Jake. So this is a topic that we added to the agenda because it's something that over the last 6 months, our advisors have been getting a lot of questions from different clients and prospective clients about this, the idea of artificial intelligence or AI, and exactly what the right way is to position a portfolio to really take advantage of this expectation of this coming wave of innovation that's going to come from artificial intelligence. And so we thought we'd walk through our thoughts on who do we think is likely to be a winner in this space. And James came up with a great idea, which was, hey, let's go backwards and let's use the lessons from the internet boom to really kind of drive some of our thinking. So we started by going back to 2000. And if you look at 2000, it was really the end of the first large technology innovation cycle around the PC and the network. And the internet was really on the horizon as the next big frontier in technology. And what we did is we looked at the top 10 companies in the United States ranked by market capitalization. Who were the largest companies? And interestingly, 4 of the 10 largest companies in the US by market capitalization were tech companies. Microsoft was the largest. Cisco in the networking space was the 3rd largest. Intel in the microprocessor segment was the 6th largest company, and IBM was the 8th largest company in the United States, really focused on hardware. And for those of you that can remember back to 2000, and I know there's a bunch of you on this webinar that remember investing in 2000. And if you take yourself back to that time, you'll remember that it was really inconceivable at that time to imagine that these 4 companies would not continue to be the innovation leaders in their industries. They were large, they were highly profitable, they were growing very fast. Investors had piled into these 4 stocks, and nearly everyone that owned individual stocks, whether it be individual investors or mutual fund managers, owned at least some of each of these companies. They were as ubiquitous in portfolios in 2000 as Apple, Amazon, and Google are today.
Mike, that's a great reminder, just as far as how powerful these companies were. I think it's easy to forget about that, right? They're still household names, but people forget they were in the top 10. They were just a part of everyone's portfolio. What I think a lot of people don't know is what type of performance have these companies seen since 2000. So what we're going to show now is if you looked at these companies from the beginning of 2000 until the end of July, just a few weeks ago, then you can see, for example, Microsoft, its total return. So all these are going to be total return figures that look at the stock price plus any income, right, from dividends and whatnot. So Microsoft over this period saw 822% return, which is great, right? If we look at Cisco now, you see about a 40% return. Intel, a roughly 50% return. And then you have IBM that's at 154% return. Microsoft kind of stands out, and you can see the massive run that Microsoft has had in the last 5 to 8 years or so. What I think is really interesting for me, Mike, is when I look at this closer and you see Microsoft actually, if you would have bought it in 2000, you didn't break even on your investment until over 14 years later.
Wow, James, so you're saying 14 years from 2000, it took 14 years for Microsoft stock price to get back to break even, including reinvested dividends.
Yeah, that's exactly right. So it's easy to remember the last few years with Microsoft, but yeah, over 14 years to get back into the positive on Microsoft. And actually, that's not just the case with Microsoft. If you actually look at these bottom three, so you have basically everyone but IBM, that was the case with them as well, right? So 3 of the 4 were negative for over 14 years.
Yeah, and if I look out to the very right-hand side of that chart, it looks like 2 of them were literally at break even like 22 years later. They were dead money.
Right? Yeah, no, that's totally right. So I think it's interesting to look at because it would be hard as an investor, at least from my perspective. I wonder how many people could have bought these 4 companies and held them all the way, like Microsoft. Who would have held that whole time? But if I know anything about you, Mike, I know you want to look at how does this compare to the benchmark, right? And I think a lot of people on this call might be wondering the same thing. So if we look at how does this compare to just like the US market as a whole, we can see the S&P 500 over that same time period returned 388%, which again, S&P 500, the 500 biggest companies in the US. But also, what if you just own more of the broad US market? So the 3,000 biggest companies or the Russell 3000. That saw roughly a 410% return, which, as you can see, that's significantly better than 3 of the 4 from that time period. So let's play this out a little bit further. Let's say that in January of 2000, you had $1 million, right? So you have $1 million that you could invest. One option or one strategy you could have implemented is you could have taken $250,000 and put it into those big 4 tech companies that we're talking about, right? So you saw those returns, but what does that look like in a portfolio? Over this time period, you saw about a 267% return. If you would have just put all that $1 million into the S&P 500, again, the 500 biggest companies, you would have had a 388% return. So obviously that's kind of a big difference, but my mind thinks better in dollar figures. So if you can see, that's 3,666,000 compared to 4,881,000. And Mike, I know you're good at mental math, but not all of us are as good at mental math. That's a $1.2 million difference between those two. So what if you didn't just go into the S&P 500, right? We talked about the Russell 3000 as well, which is even more diversified. Instead of 500 companies, it's 3,000 companies. And actually it gives you access to small companies and mid-cap companies. So how does that compare? So if we look at that compared to the same, right, this is still the same returns from those 4 tech companies. But now if we use the Russell 3000, that would have almost a 410% return, which is roughly $5.1 million. So $1 million grew to $5.1 million. And again, that's a $1.4 million difference. So I think what's really interesting for me, Mike, is when I look at these 2 options, if you would have gone into these big 4 tech companies compared to just going into diversified portfolio, like the Russell 3000, you can see that there's a $1.4 million difference if you had $1 million invested that way. And keep in mind, the Russell 3000 is much more similar to how our clients are invested, right? It owns the whole US market essentially. The other point here as well is that you took a lot less risk, right? So instead of owning 4 companies, you had 3,000 companies. And just imagine if those 4 companies, none of those 4 went bankrupt, but you had that risk. Whereas if a company went bankrupt and you own 3,000 companies, it's just a blip on the radar.
Yeah. Yeah. Once again, proving diversification is your best friend.
Yeah, that's exactly right.
So you might be asking yourself, now, what in the world does this have to do with AI? So let us kind of bring this together for you. So if we go back to 2000 and we look at the largest companies in these 4 different segments of technology, right? What did we notice? We noticed that these were large companies in any industry. And what we see over time as we look forward to 2020, we then look at who are the market leaders in each of these four technology industries in 2020. And at the top, you'll see that not only did Microsoft remain a king in the software space, but they ended 2020 as the second most valuable company in the United States. If you come down and you look at the other three, though, Cisco on the networking side, it was the third largest company in the United States in 2000, right? If you look at what's happened to that space, Amazon and Google have completely taken over the cloud. Cisco completely missed cloud computing, and Amazon and Google have become the third and fourth largest companies in the United States in 2020, completely surpassing Cisco, who didn't show up anywhere in the top 100 largest companies. If you look at microprocessors, Intel completely stopped innovating and gave way to NVIDIA, whose market cap now is multiples larger than Intel. And then finally, on the hardware side, IBM completely missed the next wave of hardware innovation, and Apple has completely taken that space over and become the world's largest and most valuable company. So large companies, when we look back, and we've done this just in technology here, but when we look back across many other industries, what we see is that large companies in any industry fail to innovate, and they lose their positions amongst the leading companies in their industry as time goes on.
Mike, I think you've laid this out nicely. So leading up to 2000, right? Leading up to 2000 was really the computing and the networking era. That was the technology that impacted those companies. Then leading up to 2020 was really the internet, right? The internet is what transformed and provided a ton of value to these companies, and not just these ones, but others. And we don't know what's going to happen, but let's say that the technology that really impacts companies moving forward up to 2040 is going to be AI, right?
Yeah.
Which I think is a reasonable assumption. We have no confidence to know what's going to happen with those companies, right? Just as we saw from 2000 to 2020, that very few of those companies, only Microsoft maintained its status as a leading innovator in that space. And when we look at AI, we have no confidence in our ability or anyone else's ability to pick those companies that are going to be the biggest beneficiaries of this change. Now, don't get me wrong, that doesn't mean that we don't think there's a tremendous opportunity in AI. What it means is we think that we have no way to know how this is going to impact us, right? If we think back to what happened between 2000 and 2020, and if you were thinking with the mindset of what you had in 2000, no one knew what was going to come with the iPhone and all the opportunities and the doors that was going to open up with social media and people having internet with them everywhere, and cloud computing and the doors that would open. And just in that same way, people knew the internet was coming, but they didn't know those were the paths it was going to take. We have no idea what's to come in AI and the opportunities that will present themselves.
Yeah, James, to your point, if we go back to 2000 and we look at the companies that innovated and dominated the internet cycle of innovation, Amazon had just gone public. Google didn't go public for 4 more years. And if we come down, NVIDIA had also just gone public. And if we look at Apple on the hardware side, they didn't introduce the iPhone until 2007, right? And they didn't introduce the first iPod until 2001. So when we look at all of the folks that dominated 3 out of these 4 segments, they were relatively small or even privately held companies 20 years before.
Yeah.
So James, if you're an investor and you're thinking about, hey, I want to be able to capture the upside of these new emerging companies in the market, what's the best way to do that?
Yeah, Mike, I think when you look at the data, it's pretty clear you should own the market, right? And that's not necessarily the sexy answer. AI is a great new topic to look at, but own the market, right? You look at the Russell 3000 and how it performed compared to these other big companies. But if you just owned the market and had that exposure, you had exposure to those smaller companies that were growing, you had a lot less stress or taking a lot less risk, and you have the ability to build a plan around your portfolio because you have an expected outcome. Whereas when you're investing in these 4 companies, you're just making a guess and you're hoping for the best.
Yeah, James, before we cut folks off, because we know we're at time, we did have one question come through. Is that right, Trevor?
Yeah, one question came in was, what dimensional fund best represents the AI opportunities?
Yeah, I think it actually, James, comes back to what you just said before, which is what we want to do is we want to own the market. And so when we think about owning the market, the DFA core funds, right? So for example, in the US, the DFA core 1 or the core 2 fund is going to most closely represent that Russell 3000. They're going to own small, mid, and large cap companies. And if we look at 2020, right, that fund, if you go back towards 2000, that fund owned Apple, it owned NVIDIA, it owned Google, Amazon, and Microsoft. Even when those companies were young, small companies that had maybe just gone public, it owned them. So I think you were right, own the market, and the funds that we use that own the market are going to be those core funds, both in the US, international developed markets, and emerging markets. Well, listen, thank you everybody for taking the time to join us today. We know we threw a lot at you, so please, on the first half of the webinar, if you have any questions going forward with respect to the operational challenges or opportunities as we move from Schwab or from TD Ameritrade to Schwab, if you have any questions, just reach out to us, let us know. We'll get you hooked up with one of our operations people that can help you. And then similarly, if you have any questions on all the information that we just went through with respect to the market in different funds, reach out to your advisor. We're happy to have a conversation with you. And until then, our operations team mentioned another webinar coming up here in the next month. You'll get an email from us. We hope you'll have a chance to RSVP for that. And until then, have a great Labor Day.